Most people see insurance as one of those unavoidable expenses in life. You pay the premiums, hope nothing bad happens, and move on. But wealthy individuals and large corporations eventually noticed something that most people completely overlook. Insurance companies consistently rank among the most profitable businesses in the world. At some point, the people paying the biggest insurance bills started asking a very interesting question. Why continue paying insurance companies when you could potentially own the insurance operation yourself? That single idea quietly gave birth to one of the most effective wealth-building structures in modern finance. It's known as captive insurance, and that's exactly what we're exploring today. Let's begin by understanding how insurance became one of the largest industries on the planet. The concept of insurance started with a simple problem. Centuries ago, merchants transported valuable goods across dangerous oceans filled with storms, pirates, and countless uncertainties. One disastrous voyage could wipe out an entire fortune. If a ship disappeared at sea, the merchant might lose everything they had worked for. To solve this problem, people developed a new system. Rather than allowing one person to carry all the risk, multiple individuals agreed to share the burden. Everyone contributed money into a common fund, and if disaster struck, losses would be paid from that collective pool. That was the foundation of insurance. Initially, insurance focused mostly on maritime trade and shipping routes, but as economies evolved, the concept expanded into nearly every area of modern life. Homes required protection. Businesses required protection. Vehicles, health expenses, life coverage, commercial property, and countless other risks became insurable. Over time, modern economies became deeply connected to insurance because nearly every significant financial activity involves some form of risk management. Banks rely on insurance. Corporations rely on insurance. Governments rely on insurance. Investors rely on insurance. As the global economy expanded, the insurance industry expanded right alongside it. Then something extremely important happened. Insurance companies discovered they weren't simply protecting clients from future disasters. They were collecting enormous amounts of cash long before they ever needed to pay claims. Every month, millions of people and businesses send premium payments into the system. Yet claims usually arrive much later, sometimes years later. A lawsuit can take years before settlement. A company might pay premiums for decades without experiencing a major claim. Many policies even expire without any payout at all. This means insurance companies often control massive pools of cash for extended periods of time, and they don't simply allow that money to sit idle. As long as regulators are satisfied and reserves remain sufficient to cover future obligations, insurance companies can invest a large portion of those funds. In many ways, it's similar to how banks invest customer deposits while account holders aren't actively using them. This is where the insurance business becomes very different from how most people imagine it. Insurance companies don't just earn money from premiums, they also generate profits from investing the float created by those premiums. Once wealthy business owners and major corporations realized how much money was being generated through that float, they started asking a straightforward question. Why are we paying someone else to benefit from this system? Consider the amount of insurance required by a large corporation. Hotel groups insure thousands of rooms and properties. Airlines insure aircraft worth hundreds of millions of dollars. Shipping companies insure cargo moving across international markets. Real estate firms insure office towers, apartment communities, and commercial developments. Major retailers insure distribution centers, inventory, transportation fleets, and legal liabilities. As companies grow larger, insurance costs grow alongside them. Some corporations spend tens of millions of dollars annually on insurance alone. At first glance, this seems perfectly normal. Large company, large risks, large insurance expenses. But eventually, executives began noticing something. Insurance providers were becoming extraordinarily profitable by investing the float generated from those premiums. In other words, corporations were continuously feeding money into a financial system they didn't own or control. Over time, a simple idea began spreading through boardrooms and executive teams. If insurance companies are building wealth using our premiums, why don't we create our own insurance company?
That's exactly what many major corporations decided to do. They established what is known as a captive insurance company. A captive insurance company is essentially a legitimate insurance business owned by the company it serves. Rather than sending every premium dollar to an outside insurance provider, the company forms its own licensed insurance entity and directs a portion of those premiums there instead. The risks remain real. The captive must maintain reserves, satisfy regulatory requirements, undergo audits, and operate within insurance laws. If legitimate claims occur, the captive is still responsible for paying them, just like any traditional insurance provider. But one critical difference changes everything. The money no longer exits the corporate ecosystem entirely. Instead of transferring millions of dollars every year into someone else's insurance business, part of those funds now move into an insurance structure the company itself owns and controls.
Insurance company that remains under the ownership of the business itself. And just like a traditional insurance provider, that captive entity can maintain reserves and potentially invest part of the float while waiting for future claims to occur. This becomes particularly appealing for large organizations because large companies usually understand their risks better than anyone else. A nationwide hotel group already has years of data showing how often accidents occur across its properties. A logistics company already knows its historical cargo loss patterns. Retail chains already understand inventory shrinkage, theft rates, and operational risks. Once a business reaches sufficient scale, risk becomes far more measurable than most people realize. And when companies begin understanding their risks with that level of precision, they often arrive at another realization. Insurance isn't only about protection anymore. It's also about controlling the movement of capital. That's one of the reasons captive insurance became so popular among large corporations, real estate groups, family offices, and wealthy entrepreneurs. Instead of continuously sending money into someone else's financial structure, they began creating systems they owned themselves. As these structures matured, another major advantage started attracting attention: tax efficiency. Once corporations started building their own insurance entities, they discovered that the benefits extended beyond simply keeping capital inside their ecosystem. The structure also changed how certain financial flows were treated from a tax perspective. Under normal circumstances, when a business generates profit, that profit eventually becomes subject to taxation. Imagine a company produces an additional $25 million in earnings during a particularly strong year. If those funds remain inside the business strictly as profit, a significant portion could eventually face taxes. Insurance operates differently. Insurance premiums are generally classified as business expenses, and business expenses typically reduce taxable income. This means that when a company pays substantial insurance premiums, those payments can potentially lower the amount of income exposed to taxation. Under a traditional insurance arrangement, those premium payments leave the company entirely and move into an external insurance provider. However, under a captive insurance structure, part of those same funds may move into an insurance company that remains within the broader ownership structure. From an outside perspective, the business is still purchasing insurance coverage, and technically that's exactly what's happening. But behind the scenes, some of the capital may remain inside a system connected to the business itself. While those reserves sit available for future claims, they may also continue generating investment returns. The concept is remarkably similar to the float model used by traditional insurers. That's why captive insurance attracted so much attention among wealthy organizations. The structure offered multiple advantages simultaneously. It allowed businesses to manage risk internally, retain more capital, potentially improve tax efficiency, and maintain access to large pools of investable funds. Once executives recognized how powerful these benefits could become, an entire ecosystem emerged around supporting captive insurance operations. Certain jurisdictions became especially well known for accommodating these structures. Bermuda evolved into one of the world's leading captive insurance centers. The Cayman Islands developed a similar reputation. Even within the United States, states such as Vermont built legal and regulatory frameworks specifically designed to support captive insurers. Over time, specialized industries formed around these structures. Attorneys, accountants, actuaries, regulators, consultants, and investment managers all began focusing on this space, because wherever large amounts of capital accumulate, specialized expertise inevitably follows. The numbers eventually became enormous. Today, thousands of captive insurance companies operate globally, collectively managing hundreds of billions of dollars in reserves and assets. Some belong to multinational corporations. Others support large real estate portfolios. Many are tied to family offices overseeing multi-generational wealth. At this stage, insurance begins looking very different from the way most people understand it. For the average household, insurance remains a recurring expense that appears on a monthly budget. For wealthy businesses, insurance gradually evolved into something much more strategic. It became a mechanism for controlling capital, a way to keep money circulating within their own systems for longer periods, a method of building financial infrastructure around risk rather than constantly paying outsiders to absorb it. Once you understand that dynamic, investors like Warren Buffett suddenly become much easier to understand. The true game isn't necessarily about chasing extraordinary returns. The real game is gaining access to large amounts of capital. Most people dream about turning $2,000 into $2 million. Wealthy investors often think differently. Once you control significant pools of money, you no longer need impossible returns to generate extraordinary wealth. A 10% return on $2,000 is useful. A 10% return on $2 billion creates $200 million. That's where the difference emerges. At the highest levels of finance, success becomes less about discovering magical investments and more about controlling as much productive capital as possible.
As possible for as long as possible. That's exactly why leverage became one of the most powerful forces in modern finance. And very few industries generate leverage on the scale that insurance does. Insurance businesses are constantly holding enormous reserves of cash that are waiting to cover future claims. Every month, premium payments arrive from millions of customers and businesses, yet many claims may not occur until years later. That gap between collecting premiums and paying claims creates what is known as float, and whoever manages the float controls the capital during that waiting period. This is one of the key reasons Warren Buffett became fascinated with insurance businesses so early in his investing career. Most people spend decades studying how Buffett selected great investments. Very few pause to ask a much more important question. Where did he obtain such massive amounts of capital to invest in the first place? The answer leads directly back to insurance. Buffett started acquiring insurance operations many decades ago, including National Indemnity and later Geico. Those companies consistently generated tremendous amounts of float that Berkshire Hathaway could allocate into investments. Over time, the scale became extraordinary. During the 1970s, Berkshire's insurance float was below $60 million. Today, Berkshire Hathaway controls more than $170 billion in insurance float. That gave Buffett access to one of the largest pools of investable capital on the planet through insurance operations alone. And here's the fascinating part. That capital wasn't technically Berkshire's money in the traditional sense. It represented funds held by insurance companies for future obligations. Yet, while those obligations remained in the future, Buffett was able to deploy that capital into stocks, private businesses, infrastructure assets, railroads, and some of America's most valuable corporations. That's exactly why insurance became so appealing to wealthy companies and family offices. Highly successful investors don't spend all their time thinking about money itself. They think about leverage, because leverage is what allows wealth to scale. Most individuals attempt to build wealth using only their personal resources. They save part of their income, invest what they can, maybe purchase property, perhaps launch a business. Everything depends largely on their own effort and their own capital. But once organizations reach a certain size, growth stops depending entirely on internal cash. Instead, they begin using leverage. Banks use customer deposits to issue loans. Private equity firms borrow capital to acquire businesses. Insurance companies use float to construct enormous investment portfolios. That's why insurance became such a powerful financial engine. Float provides access to capital at a scale most people will never personally experience. And once billions of dollars become available, investing becomes a completely different game. At that level, extraordinary returns are no longer necessary. You don't need to chase speculative assets or gamble on the latest investment craze. A consistent 8% annual return on $2 billion produces $160 million every year. That's the power of scale. Insurance float gave Berkshire Hathaway access to vast amounts of capital year after year. As those returns accumulated, the advantage compounded into something extraordinarily difficult for competitors to replicate. This same realization is one of the reasons large corporations eventually embraced captive insurance structures. At some point, executives recognized they were continuously sending massive premium payments to outside insurance companies that were using the resulting float to become even larger and more profitable. Instead of allowing all of that capital to leave, they began keeping a greater portion of it inside their own financial ecosystems. And once you recognize that pattern, you begin seeing it everywhere. The largest businesses often control distribution channels. They control financing systems. They control critical infrastructure. Because the greatest opportunities frequently aren't found in the product itself. They're found in controlling the movement of capital surrounding the product. Insurance companies understood this principle many decades ago. Eventually, large corporations and wealthy investors figured it out as well. And that's where we'll leave today's discussion. Thanks for spending some time with us. We appreciate you being here, and we'll see you again in the next one.